Hey everyone, and welcome to this video where we will be doing a walkthrough on one of the past MAC assessments that were done. So as you can see, this is the test that was written last year, test 3 of 2023, which is going to be covering a lot of the topics in finance. Right, so this is your introduction test to finance. Now, what is very important is for you to really get an understanding of how different this is compared to the costing paper, right? Because you would notice, and this is, before I start going through the theory and all of that, um, the way the finance paper is structured, the way the finance paper is done, the way the finance paper is assessed is a bit, well, I wouldn't actually say a bit. Let me correct that. It's quite different to the way you get examined when you're doing your normal costing calculations. And for some students that's great, and it works, and for other students this is, like a bit of a nightmare, when it comes to the module. So it does differ for each student. I mean, every student is different. But what you need to do is to really get a proper approach. And I'll tell you one thing now. What we've always noticed is that students don't read. And if you guys went into any additional classes or tuition classes and all of that, you would have been told that before as well. They would have told you, you guys are students, you guys don't read, you guys, or you don't read properly, that kind of thing. And I've got to be honest with you that that is something that does tend to happen a lot, and it is very frustrating for your lecturers and for the markers. So the point of this video is to go through this test with you in a guided way so that you guys have a good idea as to how you are supposed to be approaching the paper. Okay, how you're supposed to be working through the paper, how you're supposed to be approaching the paper, how you're supposed to be going through the paper, how should you be reading it. Okay, and then obviously we are going to answer it as well. But it's important that you guys have a proper structure in place, which, gotta be honest, I don't feel like you guys really have at this point in time. Okay. So first things first, the paper is out of 40 marks, right? That's important because remember, I would have told you guys that your benchmark is to say it's 1.5 marks per module. Meaning, guys, you should be finishing this paper in an hour, right? So what is 40 times 1.5? It's 60, right? So 60 minutes is what it should take you to do this paper. It's taking you longer than that, and if you're not finishing within the time that they're giving you, which is an additional 15 minutes as far as I'm concerned, or I don't know if that is going towards your uploading, um, you know, or and you're downloading, and if time is being allocated for that, but if you've got 75 minutes of writing time and you're not getting it done in that time, that is a bit of a red flag, I would say. Okay, but that just shows you that your time management isn't quite there and your approach is not quite there, right? But we're going to refine that, right? So starting off with the instructions, and guys, this is not a waste, right? You need to look at, okay, how many questions the paper does consist of. Pay attention to this, because sometimes it may just be that you get the incorrect paper or something like that, or your paper doesn't download properly and you didn't see that, okay, if there were 2 questions, you only got 1. And then you only end up seeing this after the exam or after the paper, and at that point, you can email the lecturer all you want. The fact is, you didn't read your instructions, right? All sub questions must be answered, goes without saying. All calculations must be shown. I think that's self-explanatory. Each sub-question attempted must commence on a new page. Right, let me zoom in on this one, right? Each sub-question that you've attempted must commence on a new page. So this isn't difficult to break down, but what it basically means is all of this, part A, part B, C, D, E, are your sub-questions. So you start all of this on a new page. Okay, that is important. That is what the marker wants, and or the examiners, so stick to that, guys. Please don't be doing, part A done halfway and then you start part B on that same page. Okay, it does make it easier to mark your paper when you structure things properly, and don't just apply this for management accounting. I've always told my students for all your modules you should be doing that. So there should be clear, demarcation as to which sections you're answering and what your sections are. Okay. And then, they've given you a proposed writing time, which is great. But again, I've told you, your time management's important. So even though you're going to be looking at that, remember I said 1.5 minutes per mark. So you should be working that out here to see how long each question should be taking you. So obviously 8 minutes, rather 8 marks is the SWOT analysis. So 8 times 1.5, meaning 12 minutes maximum, shouldn't be going to your SWOT analysis. 4 marks for your risk assessment. So 4 times 1.5 is 6. So 6 minutes should go maximum to your risk assessment question, right? Looking at your cost of capital question, 10 marks have been allocated to it. So 10 times 1.5 is 15. 15 minutes should be spent on this as a maximum. I think you guys get the idea, right? So, going back. Make sure that you are familiar with your ethical declaration and your requirements, and that you're not doing anything that's firstly in contravention of this. I have to emphasize that, because at the end of the day, guys, you are studying to get a professional designation, and you are expected to behave ethically. I'm not trying to sound like a goody goody. I'm literally giving you guys some sound advice over here. This isn't a joke. It's not a funny thing. And in life, it's normally when you start off with these things which you consider small that open the door to other bigger things later on in life. So don't get on that road. It's not worth it. And if you get caught, it really just sets you up in such a negative way. And even if you don't get caught, right? I mean, why do you want that? And one day is one day, trust me, right? I mean, you fall short somewhere. So just don't get into this, okay? And don't also create or allow anything to create the impression that this has not been your own work. So please don't be behaving on Iris or whichever app you're using. Don't be behaving all suspicious and all that type of stuff, or be like, for example, students would normally study together, and you're like, okay, well, me and my study buddy will write together as well. No, rather just don't. You write in your own houses. Don't be in contact with any other students, not digitally, not in person, nothing. Okay, just do yourself that favor, guys, please. All right. So yeah, I'm not going to go through all of that in detail now. This will obviously be your uploading instructions. You guys are aware of what you need to do there. That's simple and straightforward. Okay. And I will actually emphasize on the one aspect which they've mentioned here: do not continue writing during the upload time. I know for a fact that a lot of you are going to blatantly ignore this, and I understand. I was also a student, right? But the truth of the matter is that it does eat into your submission time, and you do need this amount of time. That half an hour is what you need to up. Don't think that nah, well, it'll upload in 15 minutes. No, it won't, guys. I'm telling you, I've been on the other side of this. It literally doesn't. Okay, the system will close at that time. So even if your thing is somewhere in cyberspace, it's gonna remain there, and we can track a lot of information on this. Well, the lecturers can. So if you seem to be, well, you know what, you only started your upload at 20 past 10 or at 10 past 10, and now you want to complain that your scripts or your submission didn't upload. I mean, you're not gonna get much sympathy from your lecturer guys. It's literally, you know, just don't do it. Just upload within your upload time. Okay. So I think that's enough of the admin. But make sure that you've gone through your instructions. It's not a waste of time to read. It is worth looking through, and it is worth, getting that understanding of what it is that's expected of you. Because if you don't do this and you have a problem later, your lecturers are not going to be able to even assist you on this. Okay, so make sure that you are familiar with everything that is there and which is being provided. Okay, so now I think from this point we can delve into the question, and we're going to look at it in a lot of detail. I'm going to show you guys how you should be making notes, and what you should be looking at, and really drilling down into this whole thing. Okay, it's very important for you guys to be doing this and to be obtaining that understanding of all of this. Okay, so let's start off. Right, let me zoom in a little bit. Right, so My Taxi Limited. All right, immediately from here we can already see that there is something which we would need to be highlighting. Right, now why is this important? Okay, why is this important? Why, in your mind? Type in the comments or type in the chat. Why do you think it's important? Already, first things first, I've already highlighted two words. Right, My Taxi Limited. Why is that relevant? Okay, so the answer you're looking for, right, assuming you've taken some time to think about this, is that what does it tell you when a company has the word limited at the end? That it is a company on the one hand, but that it is a listed company. Right, so if something is a listed company, right, what does that tell us? It tells us that the company can issue shares. Okay, that's what it tells us, right? Because the company's shares are on the stock market, and the company can issue shares to the public, assuming that it has sufficient authorized share capital to do so. But its shares, it can issue them to the public, and its shares are publicly traded. Okay, so that is very relevant for us already, because when it comes to a financing question or sources of financing question, we know that issuing shares becomes much more relevant now. And in most cases, you will get a public company for that reason in your assessments going forward. Okay. It also means that the market value of the shares is much more readily available because of the fact that it is a public company. So it would have a market, and obviously it would have a market value. Okay. So again, My Taxi, right? That's the name of the company, is an authorized financial services and credit provider. Okay. So that's another thing already, right? Authorized financial services and credit provider. Okay. Now, this should already tell you, okay, this is information about the industry in which the company is operating. Okay. Now, here's the thing. Whenever a company has a certain industry, you know, and this will be given to you in the test, it has to be given to you, right? You need to be thinking about things like, okay, what are the risks relating to this industry? What does this industry look like? The good, the bad, the ugly, right? That's what you need to be thinking in your mind, because these are the aspects that would affect your risk assessment, and they would also affect your SWOT analysis. And you'll see that as you go forward, right? So, the industry in which you operate in, that tells you a lot about what the company would be facing, what regulations there may be in that industry, the risks that are prevalent in that industry, what the day-to-day operations would be looking like, what the nature of the industry is. So obviously, if this was the automotive industry, then it would have been very different, to what a financial services industry is. Okay. Then goes on to say, listed on the JSE with a market capitalization of 360 million at its most recent financial year end, which is the 30th of June, right? So listed, I would also have highlighted this, right? And on the JSE, right? Because, so here's the thing I want to just, early on I mentioned that the moment a company it says limited, it tells us it's listed and the shares are publicly available, right? So I just want to make a bit of an amendment to that comment. Okay. Yes, the company's shares can be issued to the public, but again, it needs to be listed. Not all public companies are listed. So the question has to tell you that the company is listed, and it'll typically tell you where it has been listed. So it can be listed on the JSE, or it can be listed on the New York Stock Exchange, etc., etc. But in most cases, it's going to be listed on the JSE, right? And there were, the market capitalization of 360 million. That is something that is super important. So, because that market capitalization, do you guys understand what is meant by market capitalization? So just type that, in the comments or in the chat. In the chats, what is meant by market capitalization? What is market capitalization? Okay. And these are the types of terms that you need to be comfortable with. Because if you don't even understand what this means, it's going to be very difficult for you to read the question and to understand it, right? So, your market capitalization, in simple terms, is the total market value of all of your shares which have been issued. So, basically, you'll say the total number of shares issued times the market price will give me my market capitalization, right? So, that is very important because we can use that to calculate other amounts. So, for example, let's say they said 360 million is the market capitalization, and they said that there were a million shares in issue. From that, I can calculate how many shares, or I can calculate rather what the share price is, because I can take the 360 million all over my million shares in issue, which will give me 360 rand per share. So that's very important. So that's what you need to be doing. When you get market capitalization, they're giving you that to help you calculate the number of shares that you have, or in issue, or the price per share at that date, right? So one of the other two pieces of information will be given. At its most recent financial year end, the 30th of June, and needless to say, this is important because it's telling you the financial year that you are working with. Okay. So the company was founded by two brothers whose vision is to empower South Africans to become financially independent taxi operators. So they've given the vision over here, and that's a great thing. That's a wonderful thing. Not necessarily something that you need to highlight, but I would at least underline it, or maybe just be aware of what it is their vision is, because the vision would tie into the strategy of the company. Okay. So that's important for you guys to to really be mindful of. Okay. That what is the strategy of the company, and how does it link to the vision over here? Okay. And now the question goes on to say a recent study shows that 30% of South African commuters prefer minibus taxis as a reliable and accessible mode of transport. Right. So this information wasn't given for the sake of giving you information. This information's given for the purposes of breaking down, what this industry is looking like. Okay, so if 30% of South Africans do prefer this as a safe and reliable, okay, well, I didn't say safe, but it said reliable and accessible mode of transport, it's telling us in an indirect way. I mean, I would say 30% of South Africans using a minibus taxi is quite a huge chunk of the population. And it's telling us that there are good long-term prospects for this. Definitely the current term is actually looking very good. Definitely there is a demand for this. Definitely there is a strength here. I mean, I would consider this to be something that's a positive, right? Because it's showing 30%, and it says a recent study. So this isn't outdated information. If they told us a study conducted 10 years ago, revealed this information, then you'd be like, well, this was done 10 years ago. I mean, how relevant is this information? How credible, how applicable? Do you get what I'm saying? Because at the end of the day, it's not, so many things could have changed from then to now. Right. So my taxi provides its clients with a finance solution to help taxi operators, which are referred to as taxipreneurs, buy taxis and build sustainable businesses. Okay. So that's something that is good to see, right? So there is a finance solution here. So let me highlight finance solution. Okay. Traditional South African banks are reluctant to provide funding to aspiring taxi operators as financial assistance to these taxipreneurs is considered high risk due to limited credit history. So this is something that I would also highlight now. This is very important. Okay. So let's say. So all of this I would highlight. And this is very relevant because it's already telling us a threat, a risk, and something that could obviously impact us negatively, or rather impact the clients negatively. Okay, because let's think about it, right? The banks don't want to give finance for this, right? Now, if a bank doesn't want to give finance, it's only going to be because the bank feels, this is too risky for us. The chances of us getting a return are low, and and the question has pretty much outlined this. They haven't been vague about it. I mean, the question tells you straight out, straightforward, that you know, providing financial assistance to taxipreneurs is considered to be risky because of the fact that there is a limited credit history. Maybe there isn't even a credit history at all, right? So that's obviously a threat to us because these brothers are, despite this, are going ahead and they are still, providing financing to these taxipreneurs. They pretty much being very, you know, I'm not really sure what the word is, not generous, but, you know, they looking at it from maybe, a more sympathetic side and, giving financing, even though it's not really, a sound business idea because it's got a lot of risks. So this is something that needs to be taken into consideration when you're doing a SWOT analysis and a risk assessment, because obviously it is something that we need to consider. Okay. So that's something I would highlight. Now, the next paragraph, and this is interesting, right? Says that in order to mitigate these risks, my taxi uses the services of a third party company, right? So I would highlight that. To conduct the due diligence on all new loan applications. Okay. A prospective client must meet a set list of criteria to be approved. My taxi has just spent a substantial amount of money to procure a new system with machine learning capabilities where all this data is stored. So I would highlight that as well. The new system ensures a seamless application process, which makes it easy for an individual to apply for tax finance. Okay. So let's chill a moment on this paragraph, right? This sounds fine and well, right? Because you'd read this and you'd be like, no, my taxi are being very, very good. They're being very responsible. They've appointed a third party service provider to do this whole due diligence. Right. However, you need to consider whether this third party is actually reputable, whether they're credible, whether they are reliable, and whether they have experience when it comes to things like this. Because otherwise, he could have, appointed a third party. That third party could be, one of their cousins who, you know, has no experience in this. He just decided, well, now I'll just start up a company, and they're like, okay, cool. We'll appoint you, to do our due diligence. But the guy has no experience in ever doing any sort of due diligence ever in his entire life. But on paper it just looks like, hey, we've taken, steps to protect ourselves, protect the company, protect the shareholders. So it makes it just look, like, hey, this is something that we're being very proactive about. But in the meantime, like I said, it could literally just be a fly by night company or a fly by night service provider. So the fact that they've appointed someone is not in itself strong enough to be a risk mitigating factor. It's a step in the right direction, sure. But without a doubt, they need to be, taking it a step further and mention that, the company provide, or, the company which has been appointed has sufficient skills, experience, staff to do such a due diligence. Okay. And it's a third party company, so remember, we need to be very mindful about, what, all of these factors that I've spoken about. Like, is this company reputable? Are they reliable? Do they have a good, reputation? For example, like, they're not a company that's been involved in unethical things, that kind of, that those are factors that should start, ringing through your mind. Okay. Now, the next bit of information that's also important is to say that My Taxi has just spent a substantial amount of money to procure a new system with machine learning capabilities where all this data is stored. Okay, great. So they've made a significant capital investment. Now, what does that tell you? I mean, take a moment to think about it. I mean, and let's think about it. Okay, they've spent a substantial amount of money on this, right? Now, what does that tell you? And the answer isn't that they spent a lot of money. Yes, we know that they've spent a lot of money, but what is the implication of this? So you can type that in the comments, or you can, um, put that in the chat. What is this telling you? What is the implication? Okay, I think that was enough time to think about it. So, if they've spent a significant amount of money, your first question should be, okay, where did this money come from? Okay, was it internal funds? Was it external funds? If it was external funds, how was this, obtained? You know, so these are, your starting point basically for that. Then they've spent a substantial amount of money, so we need to make sure that, okay, what is our liquidity position looking like? I mean, did this company spend so much of money that they've spent so much on it, and it's actually impacted their short term liquidity? Should really hope not, but it's something we need to consider. And then the last one, or that there's still more, but the last one that I'm going to be considering is to say that, okay, they've spent a substantial amount of money, so it shows that they really believe in this. They're very committed to it. Otherwise, why will you spend so much of money? You know what I mean? You're not going to spend a whole bunch of money on something that you have no faith in. Doesn't make sense to do that. Okay. So that's something that you need to, be thinking of. And, that's, the crux of the matter, basically, right? The new system ensures a seamless application process, which makes it easy for an individual to apply for taxi finance with My Taxi. That's fine and great and wonderful, but that's not really addressing the potential risks that we'd be interested in. Okay. And to be perfectly honest, I mean, if you're spending so much of money, the system sure as hell should be creating a seamless experience. So yeah, nice bit of information there, but not, quite impactful for our purposes. Okay. So now the next paragraph is giving us the business process relating to this. And this is important for you to understand, right? So, number one, the client identifies the taxi that they would like to buy at a dealership of their choice, okay? And then approaches My Taxi for funding, okay? The taxi is essentially purchased by My Taxi on the client's behalf once it has been paid up over a specified period. Okay, so let's look at that again. The taxi is essentially purchased by My Taxi on the client's behalf. Jeez, typos in the exam. And once it has been paid up over a specified period, the ownership will pass to the client. Okay. The company charges its clients higher interest rates than other formal banking institutions. So that's something I would also highlight. All of this is actually, important, to be honest, but, you know, I've highlighted this point for a reason, to say that at the end of the day, this is linking to your finance very, very directly, right? So that they're charging them higher interest rates, that is to compensate for the risk, because they're basically saying, hey, another bank or another institution won't give you finance. I'm still giving you finance. I'm doing you a favor, but I'm taking more risk on me. So I'm going to I need to compensate myself for that risk and my shareholders for that risk. So that's a good thing, right? Or a sound thing, or like, it makes sense to do that, right? Let's put it that way. But on the flip side of things, guys, it's going to result in individuals with no formal credit history, right? No record of borrowing, etc., being subjected to monthly installments that would be a lot higher than what your market rate is. So, what does this tell you? These guys that are getting the finance, in the first place, they not, they have no history of normal market related, loan agreements and making, no history of making payments and things like that on normal market related terms. And now here we are giving them installments on terms that are higher than that. So does it not give us more of an indication or increase the risk of defaults, basically? So that's what you need to be considering. Okay. And that's what you need to be taking into account, because it suggests this, or this is an implication of this, and that, you know what, these guys are more likely now to default. In any event, they were risky enough to begin with. Now you're making it a little bit, yes, to compensate yourself, which is completely fine, but as you are obviously now going to be increasing the interest rate, their premium would be increased or the installment would be increasing, and their risk of default would be increasing, which would obviously impact my taxi in a negative way. Okay, let's move on. Throughout the duration of the finance period, the clients are responsible for fuel, insurance, repairs, and maintenance. So that's also something that's important. Okay, so this tells us where the day-to-day operations and running of these taxis, who does it fall with? So at least with us, it's not, you know, um, going to be our problem. Okay, their fuel obviously, I think it would be a nightmare, for us to, as an entity to handle that. Same thing with the insurance and the repairs and maintenance. If it's new, then well, that might be covered by the dealership as well. But the crux here is that it's not on our head to deal with. Okay. At any stage during the agreement term, if the client cannot repay the interest plus capital portion as contractually agreed, steps are taken to recover the amounts owed. Okay, so I'd say, what are these steps? So obviously there would be legal steps, or at worst, my taxi repossesses the taxi from the client. Okay, only once the payment term is over and all payments are made, ownership of the taxi passes to the client, and together with legal ownership. I guess that's a little bit redundant if you ask me. But it's basically self-explanatory on that one, right? The responsibility for paying all other costs remains with the client. That ties in there again to what we were looking at over here, right? So that's fine. So that's not too complicated to break down. That's actually quite simple to break down, I would feel. I don't think that, that's a very complicated business process. Okay. The 2023 financial year was challenging for my taxi. I mean, this is, needless to say, goes without saying. I mean, if the 20, it's telling you, the question is telling you outright that there was a financial year that was challenging for your entity, right? It's telling you then, which is the current year. And this says so many things. Okay, and make this interactive. Type in the comments like what would this be, you know the implications of this. That's what you need to be thinking about, right? So here they're giving us reasons as to why, right? They're saying soaring interest rates and a declining economy in general put the company's liquidity under pressure. So that's very important, right? Soaring interest rates is one thing, but our liquidity is under pressure. And that ties in even more now where we were looking at this, where they spent a substantial amount of money, right? So liquidity is definitely a big thing here, right? And that's why I'm going to then highlight it. So this is a theme that is coming across very strongly, right? That the company's liquidity is definitely under pressure. Now, it's nice to read this, to say, okay, yay, the company's liquidity is under pressure. Now we know this. But what does this mean? What do we mean by liquidity in the first place? What is liquidity? Because what's the use of knowing that the company's liquidity is under pressure if you don't even know what is meant by the company's liquidity in the first place? You get what I'm saying? So it's all fine and well to say that the company's liquidity is under pressure, but you need to break down this information and actually understand what this means. Okay. So think about it for a minute, actually. Think about it. What? Because again, this you're not going to learn if I'm going to be, giving you the answer for everything. And you need to start thinking. And why I'm saying this is because it's sort of like, when you go to the gym or when you exercise, right? You would be strengthening your muscles, you'd be exercising, right? If, let's say, you use a crutch every time, you're not going to grow, you're not going to strengthen yourself, right? Because you're not used to exercising that muscle, right? You're not used to walking or whatever the case is. So the same thing comes now with thinking. And that's why the OES method and all of that, backfires on so many students. Because now when you actually have to sit and think, it's like something foreign to you, right? So on this point, right, think about it. What is meant by the company's liquidity? What do we mean by this? Okay, so I think that's enough thinking time. So, without overcomplicating it, right, what is meant by the company's liquidity is, or what the company's liquidity basically refers to, is the ability of that company, doesn't actually only be a company, right? It can be any entity, to repay its debts or to pay its debts, settle its expenses, etc., in the short term, right, within 12 months. Right, so that means, within the 12 months, can the company pay its expenses? Its operational expenses, can pay, the creditors, for anything, that obviously there would be debts that would be, um, like your normal trade creditors, your short-term debt, those kinds of things, which would obviously, all of its operational expenses and credits can be settled. Basically, the company is not going to have a problem in doing this and be like, oh, now we can't pay our supplier for stock, we can't pay our rent for the month. We're not in that kind of a position. So that's what your your liquidity is talking about. So right now the company's liquidity is under pressure. So what is that saying? It's saying that the operational expenses, and creditors, these are at risk of not being paid by the company, right? Not because the company doesn't want to. They're not deciding that now we're just not going to pay our staff their salaries, for example. They are actually under pressure because they just do not have the funds readily available. The money is not there. That's what it means. Okay, so that's how you need to be breaking it down. And you need to understand this in this kind of detail, because the moment you don't understand it in this detail, the moment you don't break it down, the moment you try and sort of take a shortcut into understanding this whole process, that's where you're going to end up coming up short. And that's where you're going to start seeing, problems in the way that you answer. Because at that point, you're going to start finding things like, your answer not really making much sense, not talking to what needs to be addressed, not covering all of the information that is there. That is what the crux of all of this is. And that's where you need to really start, understanding how to be interpreting and analyzing the information that is there. Okay. So then we can continue. It says that a larger than usual percentage of clients defaulted on their repayments, right? What were we saying in the previous paragraph? Remember, we were discussing this there. We said that already these guys are not credit worthy per se, right? Or they don't meet the traditional requirements for credit worthiness because they don't have a credit history and all of that. Now we've been charging them higher than normal interest rates. Chances are that they're going to default, and that is what happened, right? In fact, a larger than usual percentage of clients defaulted on their fees because on their repayments, because remember, right, soaring interest rates, right? So even if those clients, maybe some of them might have had loans somewhere else, they would have been paying more there. But okay, they don't have much for credit history, but there is a declining economy. So your clients are also operating in the economy. Your clients are not, operating in a vacuum. They are part of the economy which you are in. Right. I mean, that just makes sense, right? Are they not in? They are in your economy, right? So if the economy is bad for you, it's also bad for them, right? So if there's economic pressure, it's gonna be affecting everyone. And now because it's going to be impairing their ability to pay, obviously it's going to impact negatively on you as well. Okay. So a larger than usual percentage of clients defaulted on their repayments, leading to impairments of loans increasing by 7% year on year. A substantial amount of legal fees was paid to a law firm for legal advice, as well as debt recovery. So you can see that we've impaired loans, right, by an increase of 7% year on year. That's a huge chunk, right? And again, it's important to understand, what does this mean? It means that 7% more of our loans we've impaired this year compared to last year. The amount of write-offs this year would have increased by 7%. If we wrote off 100,000 Rand last year, we wrote off 107,000 this year. Okay, that's what it's telling us. And now a substantial amount of legal fees was paid to a law firm for legal advice as well as debt recovery. So as it is, we under, my taxi are under financial strain. They are financially strained. There is, that, aspect, that liquidity, pressure that's there. So that's already their number one. But now, over and above that being there, they are now, you know, being subjected to further pressures because now they need to go and pay legal fees and do all of that now. Right. So, do you guys see that this is just like getting worse and worse and worse? Okay. So, I'd actually highlight this entire paragraph, but I'm not going to go and do that. But at the end of the day, I hope that you guys are starting to see the big picture. And I know we've spent an hour, and I'm going to split this up into more than one video, but the idea that you should be getting at is to actually start seeing how to break down this information so that we can actually answer the question, because these are triggers that we need to be looking at. Okay, so let's look at the financial information that has been given. So we have an extract of the annual report as at 30 June 2023, which is our financial year end, right? So just let's take a look at that for, I'm going to zoom in on it for you guys to see. And I want you guys to look at it, and in your mind, I'm going to give you guys a minute or so. What do you draw from this? Because this can't just be information for the sake of, information. You can't just be looking at this information when it's given to you in an assessment as, oh, okay, well, it's information, maybe I can do something with it in the paper. No, it's, yes, you are expected to do something with it in the paper, but you're not supposed to guess what you're supposed to do. You're supposed to be reading this information, and each item there, you should be like, oh, okay, they've given me interest, this is what it's for. They've given me other income, okay, this is what it could be, potentially be for. If I don't know, how am I going to figure this out? So have a look at that, and you try and interpret that. I'm going to give you a minute just to do that. So just think about it logically, right? What does this information tell you? You've been given very specific line items in our financial statements. Okay, well, I think that's enough time for you guys to think, right? So, interest income from the financing that's been provided to our customers, right? So, let's think about it, right? What did we say at the very beginning of this? Let's go, right? What is this industry? An authorized financial services and credit provider, right? So, what is interest for a financial services and credit provider? What does interest represent for them? Interest income. So let's think about it, right? For a normal business, if you buy and sell goods, whatever you sell your goods for, that is going to be your revenue, right? This entity does not buy and sell goods, right? They borrow money. And what do they get in return for that money? Like if you sold goods, what you got from your clients was your revenue, right? What you sold it for, your selling price. So in this case, for this client, or rather for my taxi, this interest income represents their revenue. Okay, that is what should be going through your mind. Okay, and they said that it's calculated using the effective interest rate method. That's fine. I mean, I think that's good additional information to be giving. I got no issue with that information. But at the end of the day, this is revenue for the entity. Okay. Interest expense relating to the provision of financing to customers. So here's where we've been given detail, okay, on what this interest expense relates to. Okay, because we don't typically, or wouldn't be typically, borrowing money. So where does it come from, right? And this is basically coming from the money that the entity would be borrowing from someone else in order to purchase the taxis, right? So there's two sources of this. Number one is a long-term loan which amounts to 75 million rand from Saba Bank, which was taken out on the 1st of July 2020. It incurs an annual interest rate of prime less 150 basis points, and interest is paid annually in arrears. Okay, the full capital amount will be repaid on 30 June 2030. Similar loans bear an annual interest rate at prime less 75 basis points. Okay. So the first things first is that this is our first form of funding that we've received, or one of the forms of funding that we have. And it was a loan of 75 million. So to calculate this isn't going to be a difficult thing, right? If we wanted to calculate the market value. Right now, the one thing is that we are given the future value of the loan, right? And we are given the interest rates, right? Now, here's where knowing the prime rates would be very important for you guys. If you guys don't know the prime rate, then go look it up, because you're expected to know what the prime rate is, and you should be up to date with this all the time. So guys, please don't make that mistake of assuming that everything is going to be given to you. Okay, you are a student, but you are an adult as well. So you're not expected, or shouldn't be expected, to be spoon-fed everything. Okay, sometimes they will give you the prime rate, but the truth of the matter is that you should be knowing what your prime rate is. So we can easily calculate the information that is there, and we'll get to that, right? But I would start looking at what the market value of that is right now. Then 5 million debentures which were issued on the 1st of July at their nominal value, or which is their face value of 10 rand each, and which will be redeemed on the 30th of June 2026 at a premium of 6% of the nominal amount, right? So what this is basically saying, that our future value, right, is going to be this 5 million times 10, which is 50 million, plus 6%, or multiplied by that 1.06, because we are going to be redeeming it at a premium. Okay, or they will be redeeming, the debenture holders will be redeeming it at a premium. The nominal amount will need to be repaid on the 30th of June 2026, which is very soon. Okay, but the premium will only be repaid 12 months later. Okay, so that's giving us some kind of breathing room at least, right? Interest is paid annually in arrears, and the nominal interest rate on the debentures is 9.5%. The current market rates for similar debentures is 8%. Okay. So again, they've given us the market rates, and whenever they've given you the market rate for any instrument, it's because the question wants you to calculate a market value for this. Okay. So that's something that should be lighting up in your mind. Okay. Then we've come to the net interest income, which is just a normal calculation. Then the impairments of our loans, and the additional information, it tells us that the impairments of loans relate to bad debts provision on your loan amounts, right? So that's the provision for bad debts which we've created. And, from the way it's reading, to me, it doesn't sound like the actual amount of debt that we've written off, right? But stand to be corrected on that, but this is, how I'm reading it. Then the next one is looking at other income. So other income is just insurance and commission income. So at least we have other streams of income, which are good, and which are promising at least. But again, we need to make sure that we are, keeping afloat. It's, if you look at the amount, it's quite minimal. But look at our operating expenses, right? Way high, way high. And even the impairments of our loans, right? So that's what's giving us a lot of, headaches, right? And obviously putting our liquidity under pressure. Then looking at our liabilities, okay, we've dealt with the long-term borrowings already. We have a bank overdraft, so that's already, talking more and compounding the whole liquidity issue. And it says that a bank overdraft at a rate of prime plus 4% is in place to meet working capital requirements. So already that's telling us that there's a problem, because remember, what is your working capital? Your working capital, not your short term, your inventory, trade debtors, trade creditors, all of your operational needs, basically, or things revolving around your operations within your 12 months. That's what your working capital is. Obviously, now because you need a bank overdraft in place for that, that's already again compounding this whole thing. So I'm going to even highlight this, right? Okay. My taxi experienced a significant delay in collecting payments from clients due to these interest rates, right? Or the increase in the interest rates. And that's, again, so you can see liquidity is a big theme over here. The question's repeating a lot about this, right? So that should be telling you something, because the question is not leaving this. It's really hammering this on the head a lot, right? And they're really going into detail on this. They're not, sort of just, mentioning it once or twice in the paper. They really hammering on this, right? So there's a reason for it, right? Then is the total number of ordinary shares is 10 million, of which 80% are in issue, right? So here's the thing, right? Remember what I said, right? That they gave us the market capitalization here so we can get to the market price of the share. So if 10 million shares are authorized for issue and 80% are in issue, that means 8 million shares are in issue. Okay? That should be simple to understand. I don't think that there's a problem, to get to that, right? Now, if 80% of the shares are in issue, right? That means 8 million shares are in issue, right? What is the share price
right? So remember what I said, the market capitalization is the number of shares in issue multiplied by the share price. So 8 million times the share price is going to give us the 360 million. So to get to the share price, we need to say 360 million divided by 8. And that is going to give us the share price. Okay, so do that quickly on a calculator. I want you guys to calculate that and to actually come to an answer for that one, right? So I'm going to give you about a minute. I don't think you need a minute to do that, but calculate what the share price is. Okay, so I think that was more than enough time on calculating the share price, and you should have gotten to, I think it would be 45 Rand per share, right? And that would be the market value per share, right? Which is going to be the 360 million all over our 8 million, right? And you guys are getting marks for all of these calculations. So you guys need to be building up, the easy marks. And then the last point is that the preference share capital at par value, and these are non-cumulative, non-redeemable preference shares which pay out a dividend annually, and the market value is estimated at 85 million rand at year end. Okay, so the fact that they're non-redeemable, capital will not be redeemed, right? So the capital portion is then considered to be equity, and then non-cumulative, meaning that the dividend is not cumulative either. Obviously, that the shareholders are not entitled to that dividend payment, so you're not contractually, as an entity, obligated to make those. So the entire instrument becomes an equity instrument. Okay, so that's something that's very important. This is also tying into what you guys would have learned or done under your IFRS 9 So that's where the link for all of this is coming in. It's very important for you guys to start seeing that, right? Now, the taxi rental project. So Mr. Xolani Nkosi, who is the CFO, made the following statements. Okay, the 2023 year, or rather the 2023 financial year was a difficult one. Consumer confidence remains low amidst rising inflation, increasing lending costs, and a declining economy in general. So he's listing out already factors that are a problem, okay, in the economy, financial risks or financial factors, basically, right? MyTaxi will introduce an additional revenue stream to its operations to hopefully boost its liquidity. We are planning to invest 100 million to buy our own fleet of 100 new generation taxis, which is basically saying R1 million per taxi if you work that out, right? Which prospective clients can rent from us. We will also have to purchase a warehouse where the fleet will be kept. It will be a rental agreement between MyTaxi and the taxipreneur. The application process will be the same, and MyTaxi will remain the legal owner of the vehicle. So this is important for you to read and understand, because it's giving us information about a new business model that they're going to be implementing. And this is something that you guys need to be very, on the money with, so to speak, right? Because of the fact that at the end of the day, remember one thing, right? That reading this information and understanding it is the only way in finance that you're going to actually be able to understand what your client's needs are. Okay. So the thing is that you cannot, and this is something that I'm not saying just as a someone that's providing academic assistance to you guys, but I work in finance, and I can tell you now, you need to know exactly the ins and outs of what your client is telling you before you can actually give them any sort of advice. So here it's important to understand what the CFO is telling us. The CFO is saying in a nutshell that, you know what, 2023 happened, right? But now what we're going to do is, instead of this whole model where we go to the dealership, buy the taxi from them, and then the taxipreneurs pay us over a period of time, and then they get the taxi from us, we're going to rather scrap that, or rather we're going to actually, we're not going to scrap that, because it's an additional revenue model, right? So we are going to now say that instead of you as the taxipreneur going to the dealership, don't go to the dealership, right? We've got 100 taxis over here. Pick one, rent it from us. That's it, right? But you will rent it from us forever. You will never, the taxipreneur will never gain ownership of the taxi. So that's a very important departure point that you guys need to be seeing, right? So it's not the same like in the first scenario, not at all. Okay. And obviously they're planning on investing quite a substantial amount of money into all of this. So the question will then be, how is this going to be funded? Where's the financing for this going to come from? All of those regular considerations which we would take or should be taking into account will now become prevalent over here, because this is what we need to be taking into account and considering. Okay, it's very important. Right. Now, he goes on further to say that MyTaxi will structure a payment deal with the clients, and the period of the rental agreement will typically be between 12 and 84 months. Okay, which, is fair enough. Depending on each client's unique financial position. Once the rental agreement is over, the taxi is recovered by MyTaxi and sold to WeBuyTaxis as is. So there is a plan on, obviously, once the taxi has been used, we're not going to keep it, right? We're going to say, okay, well, we'll get something out of it. So we're going to rent it out, plus we'll sell it and get something, okay? Rental payments will be high. Okay, that's something that we need to now look at already. Right. Rental payments will be high, but we need to cover our costs. We will cover the cost for insurance and provide a guarantee on parts as well as pay for repairs and maintenance, but fuel will still be paid by the client. We hope this venture will increase our bottom line going forward. Now, the thing of rents payments will be high. Now, automatically, this should be telling you that it might potentially lose its appeal to the market, because he's telling us outright, rent payments will be high, and he's using covering, the cost as a justification, which fair enough. But the clients, your taxipreneurs, so to speak, they might decide, well, hang on, if it's going to be so high, we rather, it's not worth it for us, and we're not happy with this, and plus we're not going to even own it at the end of the day. So why? Which will make sense. I mean, let's think about it. They might be like, okay, well, why then do we need to go and pay high prices here to this guy or to this company? And we're not going to even own the taxi at the end of the day. So for them, is there much appeal? No, the appeal is actually quite lost compared to the first scenario. And that's important to note, because you need to consider. Remember, they can have as many business models as they want. Doesn't mean that everybody is going to take it. They can say, we're renting taxis and, this is the price. But, if they're going to be like, well, it's 25,000 a month, the taxipreneurs might maybe, well, okay, thank you very much, but no, we decline. We're not going to go and spend so much. So they can have the business model there, but there's no clients to take it up. So again, right, it is something that does provide a potential opportunity, but you need to also be realistic about the size of the opportunity that is available. And at this point, I'm not sure. It doesn't look like it would be something that would be super appealing. The entity being, my taxi will cover the costs of all of this, right? So they're going to cover the they are going to cover the insurance and the maintenance. But, again, this should be covered by a motor plan and stuff like that. And, maybe the insurance, that might be, something that is a little bit, of a worry, because remember, it's our taxes at the end of the day. But the fuel will still be paid by the client, which is at least something which is a little bit, more comforting. Okay, the CFO declined to take further questions and left in a hurry. So I'd even highlight this, because why did they feel the need to tell me this? Like, why? And then in a follow-up article published in a well-known financial publication, more information on the planned fleet acquisition was brought to light. Right, so after much speculation in the markets, it was confirmed that a special arrangement was in place with the CFO's son's dealership to sell them the fleet of taxis at a very competitive price. So I think that already tells you a lot, right? There's nepotism in place. There's clearly, something that could, because remember, this needs to be going through a fair and transparent process. But clearly not. This is, looking like the CFO deciding, my son's got a taxi dealership, I'm going to give him 100 million rand, or, something thereabouts, and, start enriching myself. And remember, guys, right? Remember, this is a company, and this is a CFO who is likely a director now, right? Think of your Companies Act considerations as well, right? Are there no Companies Act considerations relating to, potential liability on your directors? Remember, your directors have a fiduciary right to act in the best interest of the company. This doesn't sound like the CFO is acting in the best interest of the company. This sounds like he's acting in the best interest of his son and himself. Because at the end of the day, hey, this is a good opportunity for them. It's a better opportunity for them. And remember one thing, right? Whether the clients take up the opportunity or not, that 100 million is going to be spent. So it looks like a way of, just getting money into the clients. From the clients into another company. That's sort of what it's starting to look like, and these are the factors that you need to take into consideration as well. Okay. Then you look at it further, right? The warehouse to keep the fleet is situated in Midrand. Okay, nothing wrong with that. And an offer to the amount of 10.5 million rand, right, was accepted to purchase the property. Okay. My Taxi has already secured a 10-year asset-backed loan from United States Capital for 2.5 million US dollars, which will pay out on the 2nd of August 2023, and this will cover some of the capital required for the taxi project. So again, what this should be reading, okay, we have the warehouse, but that's not the important information that's that's coming to light, right? I hope you guys can saw that already, right? It's not that the warehouse being in Midrand is fine unless there was some specific crime risks relating there now. But there is an offer that we've made and that has been accepted to purchase the property, so that's fine and well. But now what is important to note is that there is a 10-year asset-backed loan, which is quite substantial. I mean, it's 2.5 million US dollars. So guys, I mean, that's not a small amount of money, right? So first things first, I'd be looking at like, okay, why is there such a substantial loan that's been taken out? Because it's quite a large amount of money. And secondly, how, what is this in rand values? And this is, remember, what is it saying? An asset-backed loan, right? So what does that mean? Like, just for the general crowd or the general audience, what do we mean by an asset-backed in simple terms? I mean, it's actually in the name. So let's break it down, right? This is an asset-backed loan. Okay. This means basically that the loan is secured, number one. But what is it secured by? The assets. Right. And what are the assets of the entity? Right? The assets would be, yes, the office building could be one of them, but also, right, in addition and over and above that, what about the assets we are purchasing? The fleet of vehicles, right? So now let's start looking at it into more detail, right? This fleet of vehicles is now, potentially being offered as security for a loan. Right. It's being offered as security for a loan, which is great. It's wonderful on the face of it, maybe. But if we start thinking about it in more detail, right, you really start unpacking this now, right? What happens if we default? If my taxi does not make any payments on this loan, right? What then happens? They will end up losing their fleet of vehicles, which is their revenue source. So that's now putting them under threat. So that's the thing of having, your asset-backed loans are they would offer you typically a lower interest rate than that. But remember now, your assets now are under threat. So that's something that we need to be thinking about, right? And furthermore, it was also confirmed that all insurance, repairs, and maintenance on the fleets will be done through sole partnership with Dents and Scratch Pty Limited, of which Mr. Nkosi's brother is the owner. So clearly a lot of, well, I wouldn't want to say shady stuff going on, but, stuff that does, which may not be completely above board. You can, it's clear as daylight, guys, right? I think, the whole, pattern or theme should be clear as to what is going on over here. Okay. So now, and I know this is quite a lengthy process. We're doing so much of reading, and you guys are probably exhausted at this point, but this is how you guys need to be reading your information, right? I'm not saying you guys need to be taking so much of time, but it's taking this long because obviously I'm explaining it to you guys in detail. It needs to be it needs to be explained in this level of detail, but you guys get the point or the theme or what is supposed to be going on. This is how you're supposed to be going through this. You can't rush this process, guys, right? You need to be going through this in detail. Okay. Now we'll look at the working capital management. This is not too hectic. So the introduction of the new rental product line will have a significant effect on my taxi's working capital. Okay. And management considers two rental options. Number one, so this is how they're going to rent it out, right? Number one, all rental agreements have a standard 60-month fixed payment or fixed term length rather. And the second one is, well, all the features there, right? No deposit is required. A varying interest rate that is based on prime will be applied. Okay, the payback period is fixed, and should a client opt to settle earlier, a special levy or penalty will be charged for the early termination of the agreement. Okay, and some clients will likely default on their payments, which is expected. We are expecting that to happen, and the recovery rate of this rental option is anticipated to be 95%, which is quite high. This percentage of payments will be recovered or achieved by the company or the clients that do opt for this option. Okay. Then the next option is rental option 2, where they are varying terms, right? Which basically have two terms, term A and term B. So term A is telling us that it's more, for 36 months or shorter, which will require a 10% deposit and no balloon payments. And the interest rate varies and is linked to prime, and it's got quite high recovery rates. Okay. Rental term B is longer than 36 months, but it can extend to 84 months. So these are more our long-term rental options. And 15% balloon payment is, or rather, a 15% deposit is required, and a 10% residual payment. Okay, so this one does have a residual value attached to it. Interest is fixed, unlike the previous one, right? So this can be good and bad for us, right? Because let's say, and it's the same thing with the top one, because if interest is fixed, right, and we are receiving interest now, right, then from the one side it's good for us because the interest rate is fixed. So if we are receiving interest, if the interest rates go down, we'll still receive it at a higher rate. However, if interest rates go up, then we'll be receiving it at a lower rate, and vice versa. So we really need to consider all of this and take this into account, right? because these are things that are, you know, they require specific attention. Okay. And then the last point is that the recovery is expected to be at 85%. And this is normal, it's nothing abnormal, because at the end of the day, the longer someone takes to pay you, the more likely they are to default on that payment. So, you know, it's not something that is untoward or funny or, you know, not making sense or that kind of thing, right? So that's something that is expected, it is anticipated, it is something that, you know, we would be looking at and we would be considering. So yeah, you know, don't be overawed by that. Okay. So that's two things there that we needed to consider. And now let's move on from there, right? What does it say? No discounts are granted on either of these options. Weren't really expecting that. Other salient information. So let's see, right? The target capital structure is 60% equity and 40% debt based on market values. So that is relevant for our financing and our WACC. In the target capital structure, the ordinary shares should contribute 75% of the equity. So basically saying that from that 60% that's equity comprising of our ordinary shares and our preference shares, 75% of that 60% should be equity. If additional debt has been raised, then it will be allocated equally between the current and permanent debt instruments. So that's fine. That means it doesn't really change the weighting on the, well, you know, the total will still be that 40% relating to our debt, and any additional financing would be split equally between the current and non-current debt options that we have. But that'll make more sense once we get into the cost of capital. And then we say interest rate information is as follows. So they've actually been very generous to give us all of this information, right? Obviously, the prime rate would have changed at a lot of these dates, but I still, like, you know, I strongly recommend that you guys know what the prime rate is. Okay. Yes, they gave it here, but you know, it's not something that I want you guys just to be taking for granted. The good thing here is that, you know, the fact that they've given us the risk-free rates and the market return and beta and, you know, these kinds of things, that's already suggesting we're going to use CAPM, or the capital asset pricing model, in order to calculate our cost of equity. So that should be, you know, giving you sort of a signal, you know, in that regard. So I hope you guys did see that and that it did, you know, come across to you. Okay. And then the exchange rate information is as follows: the spot exchange rates and the average rates, and then the corporate tax rate remained unchanged at 27%, which is all fine and well. And now we get finally to the required. Now, I know that you guys are probably like, whoa, you know, we spent 1.5 hours reading this question paper, but guys, there is a lot of information that has been given inside the booklet that you do need to be familiar with, and that you do need to be understanding, you know, that this is how finance is generally asked and the information that's there, and you need to read the question. Okay. So the first question here is to do a SWOT analysis. So the SWOT analysis is not a very difficult exercise to do, right? First things first, what is the SWOT analysis? You're looking at your strengths, weaknesses, opportunities, and threats. Right. So these would be given to you in the paper. You don't have to think of these out of the blue, right? So let's start off with the first one, right? Let's look at the strengths and let's think about the strengths that are highlighted in the question. Okay. So remember, our strengths, right, relates to what our internal positives are, right? So what are our internal positives? Number one, let's look at it. So the first thing you'd always look at is how long has this entity been in operation for, right? So this entity has been in operation, and they would have given us, the dates or the time or something like this, just to say that but it seems to be an entity that has been around for a while. Doesn't seem that it was something that was started, just randomly. So we would, look at it and say, well, this isn't a new company, it's an established company, because hello, they listed on the JSE, so you'll never be listed on the JSE, just like that. Um, so the fact that they listed on the JSE is something I would consider to be a strength, right? So you would say that it's a strength because number one, it's listed on the JSE, so that means that the company would have been around for a while. It would have good processes in place. It would have a lot of things like sound governance systems that should be in place, despite what's been happening with the CFO's thing. I mean, obviously these things would be there. There's Companies Act requirements, there's the company is in the public eye, that kind of thing. Then what makes the company unique? What is their selling points? So they're offering finance to these minibus taxis that otherwise would not have been able to obtain finance, right? These minibus taxi operators would, in most cases, not be able to obtain financing from anyone for the purposes of their operations, and they would, so the fact that they're willing to give that to them and the banks are not, does show that there is some level of uniqueness in the business model that we have, which is obviously a positive. Then the next thing that we need to be looking at is to say, well, the company seems to be able to obtain funding, quite easily. I mean, despite all of its challenges, so funding doesn't seem to be a problem. They seem to be quite, reputable in that regard. Then you can see that they've also invested in state of the art systems, where the system of the machine learning, so they not investing in old technology, they're investing in newer technology, things like that are more relevant to our time, and they're not dealing with outdated things, they're not dealing with things that are not going to be around for the foreseeable future, basically, right? They are dealing with newer technologies, and they're showing that proactiveness. Then you can say another strength is that, look, when there was a problem, the company was quick to identify this, that, hey, hang on, there's this liquidity issue, and we can't just leave it, there's something that needs to be done. So they went and identified this whole revenue program. So you can see that it is a bunch of guys that know what they're doing. They're not just shooting from the hip over here. They are clued up in terms of what they're doing. They have a recovery plan. That's a strength. So whenever there is a problem, they don't just leave it. They are definitely looking at expanding, investing. You can see even in terms of how we've described the business model over there, right? You can see, like this one, with the taxi rental project. You can see that it's been done in a very good way. They know that, okay, they're going to have the taxi, they're going to have it for X amount of years. This is the process. They're going to even sell it to We Buy Taxis. There is a plan in place. So you can see that they are quite clued up when it comes to this. So this is what your strengths should be. You don't have to go and memorize a whole list of strengths and but look at factors in the question that would trigger positives for you. right? What would make you view this as a positive, right? So the memorandum would also be, accommodating into that regard, right? So you don't need to be afraid of writing, and you should not be afraid of writing. You should write and express yourself here, right? Because again, your strengths are looking at this company and saying, what is good about this company from an internal perspective, not looking at the market perspective, but what is this company as a company doing? Even its vision is, quite admirable. They're looking at empowering people. That's something, again, which would be a strength. Okay. So that's something that you need to look at. The next thing is the weaknesses. Now, the weaknesses are obviously the opposite of that, right? So the weaknesses could be that, okay, well, if you look at our business model, how sound of an idea is it to actually be giving, credits to members that the markets are not also willing to be giving? Because the normal banks are not willing to give these guys finance because there's no credit history there. There's a limited credit history, if at all. So, is it really sensible to do this? Is it really sound to do this? Is it really, so that may be a little bit of a weakness, I would think. What about things like, what about things like looking at it from the aspect of, your reliance on third parties, I would say, because they've used a third party to do the whole vetting process and to see whether, the guys that are coming through, the taxipreneurs, are creditworthy or not, then a lot of, this seems to be dependent on them. So high reliance on them. What about, the reliance on the system? What happens if the system breaks down? So that's another thing with weaknesses. Then looking at our revenue streams, they've only got one, at this point. So, it's a bit of a weakness because they should be having, multiple revenue streams in an ideal way, which is now what they're doing, but they should have had this to begin with, So they don't have that. And then obviously looking at, the whole way that this thing here was done with the rental project doesn't seem to be very, very, sound in terms of ethics or in corporate governance. So again, that's, another weakness because, what is the environment within the entity like? So it's almost like when you're doing an assessment for your, preliminary engagement activities, basically. That's what you're looking at your strengths and weaknesses like, So taking it from that perspective. And again, you don't have to go overboard with it because it's not many marks, right? It's 8 marks. So not more than 12 minutes should be going onto this question. Okay. But any other information that you can think of, that would be, relevant to you, or, relevant to your thinking, that would be a weakness. Don't be afraid to write it down. Okay. So now looking at opportunities, right? So we'll say, okay, if these are opportunities, that they basically a transportation service or financier, right? They can start offering this, not just to taxipreneurs, but to anyone, They can start looking at individuals that want, cars. They can do fleet management. They can assist with Uber, because maybe there might be Uber drivers that also want, to finance a car and be like, oh, we don't want to go the whole taxi route, but, can we not, get a car instead of a minibus, and finance it through you guys so that we can actually, get an Uber. And so that's another possibility. There might be rent to own agreements which your normal individuals, you might decide, I want a car. Banks are very, expensive. Maybe if you don't have a credit history, so they could help people like students as well, for example, that, need to get a car. And enter into like a rent to own agreement with students, that there can be another opportunity for them. then looking at the other streams of income, right, that they could generate from this, and this is what opportunities are. What other streams of income can come from this? So let's think about it, right? The guys are doing the scratch and dent, we can, let's see, if we're doing it for our vehicles, why don't we offer this as a service line for other, you know, service providers and things like that. That can be another thing, that we should consider. Why don't we, I mentioned the fleet management for corporations and organizations. We could go into a normal rental type of a business as well, where we have daily rentals for certain other cars, so it doesn't have to be a whole monthly thing. We can just be like someone like how Avis are, and look at short-term rentals. That's another option. Okay, so that's what your opportunities should be revolving around, right? Which other additional potential revenue streams can we look at and potentially get something from? And the last one is threats, right? So threats could be, saying something like, well, while it looks good, for now that there's so many, members of the population that are taking Ubers, not Ubers, taxis, but what about things like, Uber and Bolt coming up? Would that not maybe put the taxi business at risk? And there's rising interest rates. Is this worth it now for, going to be financially feasible for us to be, doing this? So that's a second consideration. A third consideration would be, okay, yes, there's rising interest rates. What about, rising fuel prices, that kind of thing? What happens if, let's say, we start looking at climate change and becoming more eco-friendly, and now we've gone and acquired a fleet of vehicles, and now governments are like, no, you know what, you must now start using hybrids or electric vehicles. Then what happens then? The routes that are being traveled on by the taxi drivers generally, are they safe? Are they not safe? What happens if the vehicles get stolen? Because that can happen. Muggings, those kinds of things. Competition is quite rife in the taxi industry. So, that's something also that needs to be considered. You guys get the gist of what I'm saying. Okay. So, that is something. And obviously, if the, legislation comes through that, changes the way, transportation is done, which there isn't really any information in the question to suggest that, but it's just something to consider, that if government decides, well, they're going to now be improving the public transport system from their end, and you don't have many taxipreneurs. The government decides, well, we're going to not privatize it, but we're going to create our own taxi service, that kind of thing. What then happens? Should that materialize? So that's the along the lines of which you need to think of when you are doing your SWOT analysis and when you're looking at your threats. So let's look at the solution actually, and then take it from there. So the solution, as you see, mentioned established brand, working systems. These points set up, in bold, are pretty much like your triggers or your subheadings in this to see, okay, fine, are these things prevalent or anything in the information given? Because this suggests that, hello, this is the strength, right? But as you can see, any other valid point, the ability to raise funds, that was fine. We mentioned a lot of these things, and we were literally just going through the paper. Substantial fees being paid to lawyers, that's another weakness, because obviously you don't want to be involved in litigation. It's not the ideal thing. looking at our opportunities, popularity of electric vehicles. So, that ties into what I was saying with climate change and things like that. You guys get the idea, right? But do you see that you don't have to have exactly the same points phrased in exactly the same way? Okay, that's not what the SWOT analysis is. The principle is what gets marked. So that's why any other valid point is something that will get marked. So the main thing with here is that you guys understand what to write under strengths, weaknesses, opportunities, and threats, and that you articulate these accordingly. Okay. The risks, the financial risks, I'm going to look at them just briefly, right? Because what is very important is for you guys to note that these are, number one, the types of risks or financial risks that you can get, right? Being your currency risk, your interest rate risk, your credit risk, and all these other ones. But obviously, credit risk, whenever you see a credit provider, anyone that's borrowing money to someone else, even if you're selling on credits, the credit risk is automatically a risk factor, right? So that's a risk that will pop up. And what gives rise to that? The fact that you are selling on credits or that you are providing finance. Why is this a risk? That's where the reason comes in, because the borrower, right, in this case it's the taxipreneur, may not be able to make the installments, may not be able to meet the installments and may not be able to pay these. And as a result of this, obviously that's going to lead to financial losses for you. So that's something that you need to be always linking it to, right? Interest rate risks, because we do have an element of financing available. We are borrowing funds. So as we are borrowing funds, obviously we're not borrowing at a fixed interest rate, but even if we were borrowing it at a fixed interest rate, there still is an element of risk there. I would still say that, because let's think about it, right? If you are borrowing funds, right, and now interest rates drop, you borrowed it at a fixed rate of say 12%, interest rates now drop to 10.5%, you've lost out, right? Currency risks, we entered into a foreign exchange transaction with someone. So we borrowed money from someone overseas. We could have borrowed money to someone overseas. We could have imported a machine from overseas. We could, anywhere you see something foreign exchange, you know that there's going to be exchange risk. And they never mentioned here that we have hedging, or that we've hedged these risks, right? But obviously, if we needed to give this as a mitigating tool, then we would have, right? And then insurance risk, I mean, this is relating to any assets that you now have, obviously, right? You would insure, but there's always a risk that the insurance will not be paying those claims out, because sometimes they don't. So that is the aspects that you need to be looking at. Those are the aspects that you need to be, very, very mindful of, because at the end of the day, it's small things like these that students generally. So the way to explain this is that you don't get marks for just saying that this is a risk. You need to say why it's a risk, okay, and what the impact of the risk is going to be. You need to be explaining it, because if you're gonna just write a list of risks down, that doesn't tell the marker anything. That doesn't tell the marker that you understand what's going on, because you can just be taking chances. You know what I mean? And that's not what you're getting marks for. You're not getting marks for taking chances. You're getting marks for writing, the correct information, and that's what you should be doing. So that's the crux of what I'm trying to get to. Okay. So this has been a rather lengthy video, right? So we're going to take a break on this one, because at the end of the day, don't want you guys going, completely overboard, with it, and how do I put it? Just yeah, it's just something and that you guys need to be understanding. So just take a moment to absorb this information that we've covered. If you guys have any questions, please feel free to type them in the comments, and we will obviously take a look at this and deal with it further. We will cover the rest of the topics later on in part 2 of this, but the main thing from this is that you are getting the theory on lockdown, right? And that you're able to understand it before we start jumping into the calculations. Okay. So that's it for this video. If you guys have any further questions, please, by all means, type them in the comments. I hope that this was very, very useful to you guys. This video will be uploaded onto YouTube as well. So for those of you who have not subscribed to the channel, if you want to receive more content like this and you found this video very useful, please give it a thumbs up and please subscribe to the channel so that we can keep this initiative going and growing as well. And make sure that you've clicked the bell icon so that you will be notified every time I upload something like this. And going through this video in this level of detail is the way you need to be taught and the way that you need to be understanding it. So obviously we're going to go in a lot deeper, and we go through that in my program, a lot deeper. But this is the structure that you need to be applying from now. But I'll see you guys in the next video. Make sure that you've absorbed the principles in this video, and practice. Make sure that you've read it. If there's anything that you don't understand, go through the question again, and it'll make sense. Okay. But for now, this is me signing off, and I'll see you guys when we're doing the next video on WAC and looking towards the sources of finance.